Most investors spend years searching for the perfect stock, the perfect strategy, or the perfect moment to invest. Yet the greatest fortunes are rarely destroyed by a lack of opportunity. They are destroyed by something far more ordinary: emotional decisions made at exactly the wrong time. The golden rules for building wealth that most investors ignore have little to do with predicting markets and everything to do with controlling behavior when uncertainty strikes. Protect your wealth. Those three words sound simple, but they hide a truth that separates lasting wealth from temporary success. Markets rise and fall. Headlines change daily. New opportunities appear every week. Yet the investors who survive for decades understand that protecting wealth often matters more than growing it. The surprising part is that most people discover this lesson only after paying a painful price. There is a question hiding behind every financial success story. Why do some investors consistently preserve and grow their wealth, while others, despite having access to the same information, repeatedly sabotage themselves? The answer is not found in secret formulas or market predictions. It lies in a handful of principles that many people know intellectually, but almost nobody follows consistently. In The Intelligent Investor, Benjamin Graham revealed a framework that has guided some of history's most successful investors through crashes, booms, panics, and periods of uncertainty. But one principle in particular changes everything once it is fully understood. Ironically, it is also the principle most people overlook. And when we reach the final lesson, you'll understand why protecting wealth is not merely a defensive strategy. It is the foundation that makes every other investing success possible. The first rule of wealth: surviving your own emotions. The market rarely defeats investors. Their emotions do. Most people assume investing is a battle against economic uncertainty. In reality, the most dangerous opponent appears much closer. Fear arrives when prices fall. Excitement takes over when prices rise. Anxiety demands action during uncertainty. Confidence becomes arrogance after a few successful decisions. Each emotion feels different, yet they often lead to the same destination: costly mistakes. A fascinating pattern appears throughout financial history. During market declines, countless investors sell assets not because their investments have fundamentally changed, but because their emotions convince them that immediate action feels safer than patience. Then, when optimism returns and prices climb higher, many rush back in, paying more for the same assets they previously abandoned. Wealth quietly moves from emotional investors to disciplined ones. This is why self-control becomes a financial advantage. The investor who can remain calm while others panic gains access to opportunities that emotional participants cannot even see. Markets constantly create situations where emotional reactions feel logical in the moment, but become obvious mistakes in hindsight. The challenge becomes even greater because emotions rarely announce themselves as emotions. They disguise themselves as certainty, urgency, and common sense. That is what makes them so dangerous. A person can spend years studying investments while completely ignoring the psychological habits that determine whether those investments will succeed. But emotional discipline alone is not enough. Even investors who master their reactions often overlook another factor that quietly determines their future results. And this next principle changes the way intelligent investors evaluate every opportunity they encounter. Why paying less matters more than choosing the perfect investment. The price you pay often matters more than what you buy. Many investors spend enormous amounts of time searching for exceptional companies, promising industries, and exciting opportunities. Yet one of the most overlooked realities of investing is that even a great investment can become a poor decision when purchased at the wrong price. The market has a way of making popular assets appear irresistible. As prices rise, confidence grows. Media attention increases. Success stories spread everywhere. What began as a solid investment gradually transforms into something dangerous, not because the asset changed, but because expectations became disconnected from reality. People stop asking what something is worth and start asking how much higher it can go. This is where intelligent investing separates itself from speculation. Successful investors understand that every purchase contains both opportunity and risk. Paying too much reduces future returns before the investment has even begun. In many cases, the biggest mistake is not choosing the wrong company. It is choosing the right company at the wrong price. A simple shift in perspective changes everything. Instead of chasing popularity, intelligent investors focus on value. Instead of asking whether everyone wants an asset, they ask whether the current price leaves room for mistakes, uncertainty, and unexpected events. That small difference creates a completely different outcome over time. The uncomfortable truth is that markets eventually expose every overpriced decision. What appears safe because everyone agrees often becomes dangerous precisely because everyone agrees. And this leads directly to the next principle, a concept designed to protect investors when reality refuses to follow expectations. What comes next is not about making more money. It is about ensuring that one mistake never destroys years of progress. Building a financial fortress before chasing higher returns. The investors who last the longest are rarely the ones who take the biggest risks. One of the most expensive misconceptions in investing is the belief that wealth is created by constantly seeking higher returns. That idea sounds reasonable until reality intervenes. Markets are unpredictable. Economic cycles change. Unexpected events arrive without warning. And when they do, portfolios built only for growth often reveal how fragile they truly are. The most intelligent investors think differently. Before asking how much they can gain, they ask how much they can afford to lose. This mindset shifts the entire objective of investing. The goal is no longer maximizing every opportunity. The goal becomes building a structure strong enough to survive uncertainty while remaining positioned for future growth. This is where financial resilience begins. Every investment decision carries unknown risks, no matter how attractive it appears. A margin of protection creates breathing room when assumptions prove wrong. It recognizes a reality that many investors struggle to accept. Being slightly wrong is normal. Building a strategy that survives being wrong is what separates professionals from amateurs. History repeatedly rewards this approach. Market crashes have destroyed fortunes built on confidence, leverage, and optimism. At the same time, disciplined investors with protective buffers often emerge stronger because they preserved the one resource that matters most during uncertainty: capital. Opportunities always return. Lost capital is far more difficult to recover. There is another hidden benefit to building a financial fortress. Protection creates psychological stability. Investors who know they can withstand turbulence are less likely to panic when turbulence inevitably arrives. They gain the freedom to think clearly while others react emotionally. Yet even strong defenses can fail when another powerful force enters the picture. A force capable of convincing intelligent people to abandon their own judgment. And it is responsible for some of the largest financial mistakes in history. The next principle reveals why following the crowd often feels safe right before it becomes dangerous. The hidden cost of following the crowd. The crowd can make a bad decision feel intelligent. Human beings are naturally drawn toward consensus. In everyday life, that instinct often helps. In investing, it can become a silent trap. When millions of people believe the same story, buy the same assets, and repeat the same predictions, disagreement begins to feel uncomfortable. Independent thinking starts to feel risky. Following everyone else feels safe. But markets have a strange way of punishing comfort. Some of the most damaging financial bubbles in history were fueled by a powerful illusion. If everyone is doing it, it must be right. Investors watched prices rise and assumed the crowd possessed knowledge they did not. As more people joined, confidence became certainty, and certainty became blindness. Few stopped to ask whether the underlying value justified the enthusiasm. The danger is not simply losing money. The deeper danger is surrendering independent judgment. Once that happens, decisions are no longer guided by evidence, logic, or value. They become reactions to social pressure. Investors stop evaluating opportunities and start evaluating popularity. The market transforms from a place of analysis into a place of imitation. This tendency appears everywhere. Excitement spreads faster than caution. Optimism attracts attention more easily than discipline. Success stories become headlines while warnings are ignored. By the time the risks become obvious, the crowd has already moved on to its next obsession, leaving many investors behind to deal with the consequences. The most successful investors understand something that sounds almost paradoxical. Agreement does not create truth. A decision is not correct because it is popular. It is correct because it is supported by sound reasoning. That principle requires patience, confidence, and the willingness to stand apart when everyone else is moving in the opposite direction. And this brings us to the final test. Because controlling emotions, paying the right price, building protection, and resisting the crowd all serve a single purpose. A purpose that determines whether wealth survives long enough to become truly life-changing. Protect your wealth or lose it. The final test of every investor. The greatest financial victory is not making money, it is keeping it. At first, investing appears to be a game of growth. The focus is on returns, opportunities, and accumulating assets. But as the years pass, a deeper reality emerges. Building wealth and preserving wealth are entirely different skills. Many people achieve the first, far fewer master the second. This is the question that has been quietly following us since the beginning of this journey. Why do some investors build fortunes that last for decades, while others repeatedly rise and fall despite moments of success? The answer is hidden in a simple truth. Every principle we have explored ultimately serves the same objective: protection. Emotional discipline protects wealth from panic. Paying sensible prices protects wealth from unnecessary risk. Financial resilience protects wealth from uncertainty. Independent thinking protects wealth from collective mistakes. What initially seemed like separate lessons are actually pieces of the same foundation. The irony is that protection is often misunderstood. Many assume it limits growth. In reality, it makes sustainable growth possible. Wealth compounds only when it survives. Every dollar preserved today retains the ability to generate future opportunities. Every major loss avoided protects years of progress that would otherwise need to be rebuilt. This is why the most intelligent investors do not obsess over becoming rich quickly. Their attention remains fixed on something far more powerful, ensuring that their capital remains alive, adaptable, and capable of compounding through changing conditions. They understand that financial success is not measured by what happens during a single year. It is measured by what remains standing after decades. And now the loop closes. The golden rules for building wealth that most investors ignore are not hidden secrets reserved for financial experts. They are timeless disciplines available to anyone willing to practice them consistently. The market will continue to test patience, judgment, and character. Opportunities will come and go. Trends will rise and disappear. But those who learn to protect their wealth first gain something far more valuable than temporary profits. They gain the ability to stay in the game long enough for wisdom, discipline, and time to do what speculation never can: create lasting wealth.